No matter how many strategies you're going to make before a market crash, when you see the index go down by minus 35%, I can guarantee you that you will doubt even the strongest investment strategy. At that time, it's only your own experience and discipline that will count. Now, there are tactics you can use to make money during a market crash, just like George Soros, who pocketed $1 billion in a day, shorting the British pound, or Michael Burry, who shorted the stock market during the crash in 2008, made famous by the movie The Big Short. What I will do in this video is to explain to you how these strategies work and how these people made millions from a falling market. Now, we wouldn't call this channel Profit Protection for nothing.
They do not call me Die Hard for nothing.
Make sure to watch all until the end, as we'll give you our take on these tactics and how you can use them in your own investing. Okay, so we've all heard of the stock horror show. Like Peloton, the company producing internet-connected stationary bicycles and treadmills that everyone thought was the future during the early months of the pandemic. The stock surged 725% during 2020, and then it has fallen like a knife, plunging 87%. It's almost back to where it started in January of 2020. Or the video communications company Zoom, hitting an all-time high in October 2020 and then crashing down 80%. Now, the reason I show you these examples is because not all investors lost money on these stocks. There was this group of edgy investors who were able to identify the hype and went on and shorted the stock before the bubble burst. These investors made a fortune because when you short a stock, you profit when it goes down. So, the first strategy is this: identify hype and overpriced assets and short them. Now let's be honest, identifying overhyped stocks or assets isn't that difficult, right? When your neighbor Joe, who knows nothing about investing, tells you he's buying a stock, or when it's talked about all over YouTube or in the news, it's safe to say that something has hit the hype train. Today, the market is at or close to all-time highs, and there are lots of people saying it's overvalued. Even equity strategist Michael Wilson at Morgan Stanley recently warned of a potential bear market in US stocks. The market has been so picked over at this point, it's not clear where the next rotation lies. In our experience, when that happens, it usually means the overall index is about to fall sharply, with almost all stocks falling in unison. Okay, so before you run over to your computer to place your short orders, you need to understand this, and this is important. As easy as it is to identify overhyped assets or stocks or an overpriced market as a whole, the problem is timing your trade. That is true for all trades, but it is especially important when you consider shorting the market. You never know when the hype will die off, and for all you know, it could last for several months or years. That's why I actually never like shorting stocks or shorting the market, because it's just too hard to time the market. And betting against a company or the entire market, I just don't think it's a good idea. Companies are meant to grow, and over time markets make money. They just have these short periods where they drop and no one really knows when they will occur. Okay, so that's one way of making money when the market is falling. Now, the next method is, in my view, an overlooked way to hedge and profit from market crashes. The method is this: owning companies with good businesses and, more importantly, tons of cash on their balance sheets and the ability to produce much more of it. Think of companies like Google, Apple, or Microsoft. These companies are cash-producing machines and under-levered, meaning they have little debt, or in Apple's case, could easily borrow much more. They also own businesses that throw off billions and billions of dollars of new cash every single quarter. For example, Google is sitting on $169 billion of cash and just $14 billion of debt. It has a net cash position of $155 billion relative to its $1.588 trillion market cap. This means that when you buy a Google share for $2,373, $231 of that $2,373 is backed by cold hard cash. More importantly, over the past 12 months, Google produced more than $91 billion in operating cash flow thanks to the strength and magnitude of its businesses like search and YouTube. So for every $2,373 Google share you buy, you not only get $231 of cash in the bank, you also get $135 of annual recurring cash flow that's likely to grow over the years. And Google's immensely strong balance sheet and businesses can easily be used to raise hundreds of billions of dollars more via debt financing. What's so good about having cash, as well as the ability to produce more of it? Cash is one of those things that sits around doing nothing 90% of the time, but then becomes absolutely vital 10% of the time. During recessions, many companies go out of business because they can't scrape up enough cash to pay their employees, creditors, or suppliers when their revenues decline and their banks stop extending loans. During these times, companies with ample cash, extra borrowing capacity, and strong businesses can step in and start buying up their competition or enter new businesses for cheap, often cents on the dollar. The same cash that acts as a ballast during a market crash can then also be used to take advantage of the bargains provided during such a decline. The next method I'll show you is the Warren Buffett way of making money in a market crash, and this is also the one method that I personally prefer as well. I want to give you a brief history lesson to show you how this method works. In 2007 and 2008, we had the financial crisis, where not only did housing prices collapsed, the stock and financial market crashed as well. It wasn't an easy time for most investors. If we take a look, it crashed by over 50% from November 2007 to March 2009. So the average American stock investor lost more than half of their worth in just over a year. Just imagine how devastating that must feel like. They lost more than half of their entire life savings. Now, the following is what the average investor does. Warren Buffett calls this emotional investing. Just when the market is bottoming out, they take their money out of the market and put in assets that are considered safe, like cash in the bank. They pull out of the stock market and think stocks are no longer for them. And this is basically a mindset problem. Instead of panicking, you should embrace falling markets. As a value investor, you are always interested in businesses that are undervalued relative to their intrinsic value or their operational potential. During a market crash, the price of a stock falls drastically, often much lower than the respective fundamentals. This is the best opportunity for you. Don't get discouraged by the low prices. Look at them as discounts. As long as the underlying fundamentals of the company have not respectively decreased, the business is on discount. Buy it. Value stocks in a crashing market will have one of the best return on investment, especially if you take into consideration the lower risk. The logic behind it is simple. If a business is already undervalued, a falling market will bring the prices way lower than the fundamentals indicate. Buy the stock and simply wait for the market correction that will favor you. For investors who don't invest with their emotions, situations like this give an enormous opportunity. Now, if we look back at the early part of 2009, the fact of the matter is that this was the best time to invest. Most people were selling and there was blood on the streets, aka stocks are on sale. In 2007, Warren Buffett was very cautious with how many stocks he bought, and he was mainly buying bonds. But in 2009, after the crash, Buffett went on a buying spree. Those smart investors that bought up stocks in the midst of the panic and the recession were the ones who made the most profit. If you look at the market since 2009, it has increased more than 450%. So if you want to make money in the market, the best time to do so is in the middle of a crash when everyone is panicking. Now, you might say that 450% isn't enough to make you a millionaire, and I agree, or I should say, it depends on how much you invested in the first place. But I'll tell you this, you are probably forgetting the effect of compound interest. You know, the thing that Einstein called the eighth wonder of the world? As another great American, Benjamin Franklin, described it, money makes money, and the money that money makes money. That is probably the simplest explanation of compound interest you'll ever hear. Compound interest occurs when interest gets added to the principal amount invested or borrowed, then the interest rate applies to the new, larger principal. It's essentially interest on interest, which over time leads to exponential growth. Even with relatively small amounts of money, you can gain significant amounts when it's compounding over time. What you need for the recipe is a high return, which you can get by investing after a crash, and of course, time in the market. Now, the last thing I want to mention about making money from a market crash is this. Choose the right investment at the right time. It might sound obvious, but it's not. I want to draw your attention to this chart. It's a graph from Fidelity, which tells you what type of sectors do well in different parts of the market cycle. When the market starts to go down, you want to play the game defensively. You want rare metals like gold, which holds its value. You'd also want consumer staple stocks. Also, you want to consider the energy sector. When the market is contracting, like in a recession, you want to adjust your strategy slightly. Consumer discretionary and healthcare are the ones to go for. That is still needed no matter what market we're in. Now, when the market is bottoming out, we need to reposition into financials and technology because they are the ones that get beat up the most during the crash. You'd normally get them at ridiculously discounted prices, as no one wants to own them. When the market is recovering, industrials, technology, and consumer discretionary are sectors to keep an eye on. Looking back to the last recession in 2008, Apple has gone up over 2,500%, and Amazon over 5,400%. After a crash, you'd want to look for the companies that are going to be disruptive for the next 10 years. If you can pick up these companies at a cheap price and reinvest your profits, you can earn millions. So with the right tactics, you can make a great amount of money when the market is crashing. Now, if you want to learn more about how to profit in a bear market, you can watch this video. If you found this video helpful in any way, please like and subscribe to my channel. It helps us continue to bring high quality content that both educates and entertains. See you next time.